Hello everyone, I hope you guys are doing well and your studies are going in full swing. Now in today's video we are going to discuss about the September 25 RTP for your AFM. Now unlike the FR RTP which has fairly new and detailed questions, in this RTP there are a few questions like we have highlighted over here which you should refer, but bearing the Forex question which is slightly a notch complex, other questions are quite easily manageable. So what we have done is we have tried to give the referencing for the similar questions on which questions is there in our book, as well as the source on whether it is from the Institute RTP or study material, etc., so that it is easier for you to correlate. I am not going to discuss the questions which are repetitive, but we will try to discuss the new questions so that it is optimizing your time before your exam. So over here, like the other RTPs of the new course, there are 15 questions in your AFM RTP, out of which the first two questions are case study based MCQs, out of which the first is an advanced capital budgeting one, which is a replica of question number 16, which is there in our material and which is also there in your institute study material as a descriptive question. They've kind of formed around 4 or 5 MCQs based on this. The next question is on financial policy and corporate strategy. Now this is kind of a slightly theory based question which has some overlay with valuation, so we'll quickly refer that. It has one of the aspects which is similar to the external funding requirement adjustment which is there in security valuation as well as financial policy and corporate strategy. You would have done this question, but over here there's only one numerical part and there are 3 descriptive parts. Then from question number 3 all the way up to question number 14 you have descriptive, out of which question 9 of Forex is worth doing. Question 11 of M&A is slightly different, but I would say that it is easily manageable. And then in question number 15 and I think 14 you have theory questions, out of which there is one theory question which is slightly different. So we'll just focus on these 4 areas. So let's get started. So we'll review this MCQ again. I would expect you to kind of pause and read the question before you start a respective question in the video, so that you have some broad understanding and it's easier for you to kind of match up. So over here, financial policy and corporate strategy. In a recent board meeting of N, the following financials of N for the year ended 31st March 25 were presented. So you have this entire financials, you have kind of a balance sheet and you have the income statement. Next you have 3 statements which are given by 3 different directors, for which there is one MCQ for each of the statements, and the 4th one is a calculative part. So let us review it quickly. During the board meeting, Director A said that the company can maintain a certain growth even though the net profit margin remains constant. The assets increase proportionately to sales and it distributes 30% of the net profit. So even if it distributes 30% of the net profit, it has 70% which it can retain, and through that it can finance growth. To maintain this growth rate, it will not require any external funds. So there are no funds required. Now, if I go to the point 1, the Director A is talking about, I think, the internal growth rate. It is not something which is going to continue. Sustainable growth rate is a growth rate which is based on retained earnings and your return on equity, which is expected to continue on a long run basis. However, over here, it is just talking about this particular year in question and not taking any external funds. So there's definitely no external funds requirement or external growth rate. And like G is equal to R into B, that is your sustainable growth rate. So if your statement framing is pertaining to your retained earnings and your sustainable growth, that is when we call it as a sustainable growth rate. Over here we can say this is like an internal growth rate. Okay, next you have point B. Director B proposes that just by maintaining a target capital structure and without issuing any additional equity and maintaining target dividend payout ratio. So if your target dividend payout ratio is maintained, that means if your payout ratio is maintained, then your retention ratio can be kind of fixed. More growth can be achieved. Now this is a growth which is based on your retention, and you are maintaining your capital structure, that is, you're not raising any additional equity, not raising any additional debt. At the same time, you are having a target payout ratio as well, and hence I would say over here Director B is talking about sustainable growth rate. Again, we're not talking about additional fundraising. We are saying that we'll not raise any additional equity. Further, if the capital structure has to remain the same, you're not raising any additional equity. That means you're not even raising additional debt. Your payout ratio remains the same, which means your retention ratio every year is the same, and your R into B will be your sustainable growth over the long term. Now, Director C agreed with the views of A and B, but is of the view that in the coming year it expects the sales are likely to rise by 15%. Hence, if required, we can go for issue of shares, bonds or debentures. So, Director C is okay raising funds to achieve that growth in sales. So, over here, I might need certain external funds if 15% growth has to be achieved. So, Director C is talking about not internal or sustainable, because these kind of preempt that there will be no external funding. Over here, Director C is open to raise external funds, and hence your option C can be taken. If we go by the proposal of Director C, that is a 15% growth in sales, then approximately dash funds would be required in the form of equity or debt, assuming that dividend as proposed by Director A is paid out. Director A, I think, proposed a 30% payout if you see the first adjustment, and assets and current liabilities are increased in the same proportion as the sales. So for example, if I go to see all your assets, that is 7,70,000, and all your liabilities, that is 66, 88 and 44, that is liabilities worth 1,98,000, that is your total business is worth 5,72,000, which can also be inferred by 4,80,000 plus 92,000. So this is 5,72,000. Now generally the sales are to increase by 15%. All the operating assets as well as liabilities will also increase by 15%, and hence 15% of this would be your total funds required. Now a part of these funds can be raised by internal retained earnings, and the remaining will be raised through external funds. So I believe you will need 85,800 of total funds. Now out of this 85,800, some of these funds will be raised using external funds, some of them will be raised using internal. So we'll figure out how much is internal. Now we are assuming that if all else remains constant, even your interest etc will change proportionately. We are not assuming any fixed cost over here. We are assuming everything will change proportionately, because if you need more funds, that will need more debt, and if there's more debt, there'll be more interest. That is what the institute has assumed. So over here, if I have 61,600 of PAT, if sales were to increase by 15% and everything below that is variable. Now this is arguable and debatable. However, the institute has solved this assuming everything else is variable in the exact same proportion. So over here, 61,600 plus 15%, if I were to do, this is 70,840, out of which 30% will be given out as dividend, and hence the amount that you have for retained earnings is around 49,588. Remember, the existing capital structure is already deployed. So your existing capital bonds are already deployed on the assets and liabilities. Now in the next year, you are going to make profits worth 70,840, out of which 30% you will distribute, and hence the remaining 49,588 you will have with you for the purpose of running the business, even if there is a growth. However, you need assets worth 85,800, out of which I would say, out of 85,800, out of your internal accruals in the current year, 49,588 can be met out, and hence around 36,212 would be the amount that you will have to raise through external funds. So they're asking you how much money, either from debt or from equity, you have to raise. Then this is your answer. Now, if I'm not wrong, this is similar to question number 59 or so of our material, or the institute has put this as question number 1 of your financial policy. Over in that question, beyond this, there were some additional adjustments as well. That is how much of debt you should raise, how much of equity you should raise, consider long-term debt, short-term debt, considering various ratios that were given in the question. Thankfully, all of that is not there, but there is some theory part for the first 3 questions. So that kind of takes care of your question number 2. Now question number 3 pertains to convertibles, similar to question 71 of our material in RTP November 23 question. Question number 4 is a good question on immunization. It's a definite last day revision question that we have reviewed on immunization. This is our question number 24. Similar to ICAI November 18 exam question and a few other MTP questions as well. If you have not done this, you do this properly, because in bonds this is a good concept on duration as well as immunization. This is on business valuation, but we have put this in portfolio regarding geared, ungeared beta, portfolio beta, similar to RTP May 21 question. So this is from portfolio. On derivatives, the institute has asked you both questions pertaining to commodity derivatives. The first subpart was that rice trader wala question, which is a last day revision question typically that we say, question number 18, and it is similar to the ICI RTP question of November 20. It's a good question on deciding your strategy on whether you should go long or short on the futures. The sub point 2 is a commodity future question again. I think question number 15, which is there, similar to the ICI RTP November 21. Over here, they have asked you to find the optimal hedge ratio, which is nothing but the beta, considering the standard deviation, correlation, etc. One can find the beta and the position to be taken. So if you're long in the spot market, you will take the opposite position, let us say being short, it is kind of the same, and how many contracts should you enter to take a perfect hedge. Question number 7 over here on interest rate risk management, similar to question 5 of our material and ICI RTP May 21. So is a lot of 21, 20 RTP questions being recycled over here by the institute. This was definitely a last day revision question where you had this situation where you had to study the possible hedging using interest rate futures as well as forward. So this was the one question where both get tested. Question number 8 on portfolio, and initial question 4, again a last day revision question, which was there where you had to find the portfolio return and the weights which are there, and you also had to find the standard deviation. So this was interesting. And then you come to question number 9. Now after all of this just general discussion on the questions which are there, this is a good question. I'm not really saying that this is an unsolvable question, but it has some adjustments of foreign exchange which kind of make it a little tricky and confusing, especially selection of bid and ask rate, whether you need to multiply, whether you need to divide, etc. So let us get started. On 1st of February 2025, XYZ, who is a laptop manufacturer, imported a particular type of memory chips from SKH Semiconductor of South Korea. So XYZ, who is an Indian company, is an importer. They need to probably pay the South Korean won. The won is written something like this. You write a W and double line, like a yen. You have the double line similar to that. Even if you don't write the symbol, that's fine. So the payment is due in 1 month from the date of invoice. So from 1st February 25 to 1st March 25. So it is 1 month where you have the foreign exchange exposure. The payment is due in 1 month, amounting to 1190 million South Korean won. The following spot rates on 1st February are quoted in 2 different markets. So if I have tried to solve this question over here, so if I go to see, if I am XYZ, as XYZ, for example, who is an Indian company, they have to pay to the South Korean company, and that is payment is made in won. So the risk is with the Indian company for changes in currency over the 1 month time frame. Okay, so we are clear with the facts of the case. Now the rates which are given are interesting. This is USD INR and USD to South Korean won. So when you look at the USD INR rate, now this is like those SWIFT codes that you have, where you look at the market convention and you kind of ask yourself on whether this is the rupee to dollar rate or the dollar to rupee rate. Like when the rates are given in caps, 3 digits, like the SWIFT codes that we have discussed over here, you need to be like literally this rate appears to be dollar per rupee. However, if you look at this rate as dollar per rupee, is 85 the dollar per rupee rate? No. This is similar to rupees per dollar. We have discussed this in class and showed that even if you kind of Google up and you just type USD INR, the rate that you are going to get is a rupee to dollar rate. You type INR USD, the rate that you get is the dollar per rupee rate. However, institute solutions over here have been a little inconsistent at cases, and hence we recommend you ask yourself regarding the strength of the rate. Like the USD INR over here, the dollar has a higher denomination as compared to the rupee, and as a result 85 is per dollar, that is rupees per dollar. Now if this is kind of applying the market convention, the Swift codes, then all rates are like that. So over here, USD to now you might not know the strength between the USD and the won, but if one of the rates USD INR is given as rupee per dollar, then this will also be, for example, won to the dollar. So the rates that are given over here, these are, I think, the 1st February 25 rates, applying the market convention in this particular case. Now, since hedging of foreign exchange risk was a part of the company's strategic policy, no contract for hedging of South Korean won was available in any inshore, that is in the Indian market. It approached an offshore non-deliverable forward. Now, this might be a slightly different term. Now, we have usually done a lot of cases regarding forward, and in forward it is a customized tailor-made contract between you and the bank, and hence usually forwards are deliverable. So you go to the bank, you agree to a forward deal, and on the necessary date you go and make the full payment and take the delivery of the foreign currency. If you are an importer, you will buy the foreign currency. However, it is clearly given that this is like a non-deliverable forward, which means this is a forward like a future, I would say, which will net settle. There will not be a delivery, so there will be a rate at which probably I will buy, and the net settlement will happen at the expiry, where the difference between the rates, if I am gaining, I will receive, if I am losing, I will pay. So that is if I enter into hedging under the non-deliverable forward market for hedging the same risks. Okay, in the NDF market, the dealer quoted 1 month USD SKW, that is won per the dollar, at these rates. So there is bid and ask, your favorite adjustment, to be settled at the reference rate declared by the Bank of Korea. Now, after 1 month, the dealer agreed for 1385 as the rate for settlement. This must be the rate given by the Bank of Korea, and on the same date the spot rates in the markets were as follows. So maybe the rates given by Bank of Korea are slightly different from the rates which are there in the market as well. That is very much possible. So now a thing that you kind of need to remember over here is, you will review this question once, just a second. USD INR, USD SKW, again this will be read as rupees per dollar, and this will be read as won to the dollar, and this is on 1st of March 2025. I've solved this in our method in the board notes, and I will share this with you on the Telegram channel as well. But again, there are different, I mean, if you have taken classes from us, you will be aware of this method of solving. If you have taken from somewhere else, there will be a slightly different method of solving. Different professors have a different way of solving, but all of that will come to the final same ultimate conclusion. So you can apply your method and come to the ultimate conclusion. So your answers will be exactly the same. Marks in the exam will be exactly the same. Analyze the position as under in the following cases by comparing with the spot position on 1st February. You are not just blindly asked that which of the alternatives are better. You have been told a way that you compare the cash outflow, because you're an importer, you will ultimately pay on 1st March, and compare it with the 1st February cash outflow, and you figure out your gain or loss and select the most appropriate alternative within doing nothing, that is keeping the position unhedged, and opting for the NDF contract where you hedge in the NDF market. Now both rupees per SKW rate. So you're being told that the relevant rate that will be needed, because you are an Indian company and you're importing from South Korea. You in this entire question don't have a rupees per the won rate. You have the rupees to the dollar rate, you have the won to the dollar rate. So over here you'll use the concept of, concept of cross currency. That is right, you'll use the concept of cross currency. You'll arrange the rates in such a way that your dollar and dollar, which is the intermediate currency, will cancel, and rupees will ultimately remain in the numerator and won will ultimately go into the denominator. So if you do nothing, then the transaction will settle at the 1st of March spot rate, cross currency spot rate. Here the challenge will be deciding the bid and ask rates, but we'll do that quite easily. Should not be a problem for most of the students. And the final payment to be computed in rupees lakhs. Abhi ye karna chahiye nahi tha. Now you have been given half the data in million, then you are saying give the answer in lakhs. Yaar million mein hi rakho. But abhi institute ne bola hai, so we'll have to do this. So we'll compare. What I have done is I've converted everything into lakhs at the onset only. So when you look at this, 1190 million, that is basically 11,900 lakhs. End of story. So everything that I have solved is considering 11,900 lakhs only. So my answers directly come in lakhs only. Now institute, if you see some places in the printed solution, they have taken millions, some places they have taken full numbers, some places they have taken lakhs. So when you revise, looking at that, you are a little baffled कि यार ये number यहाँ पे क्या हो रहा है. So we have converted everything into lakhs and all our solutions, all our points are going to come in lakhs only. चलो ठीक. And to be rounded off to 4 decimals. Thank you very much, Institute. This is one thing which harasses the students at a lot. How many decimals should you round off? The typical thumb rule that we take is 4 decimals for the exchange rates and discount factors. However, for the amounts, you can round off up to 2 decimals. But here, because they have clearly told you that round off to 4 decimals, we will round off everything to 4 decimals only. Okay, great. So over here, if we kind of try to see the adjustments, and I'll just run you through the solution which is there. Now we have been told to compare the gain or loss if you do nothing and the gain or loss if you were to take it an non-deliverable forward. So let us first focus on part 1 where we kind of do nothing. If you do nothing, then the transaction will settle in at the spot rate on 1st of March. Now the problem is, what rate should you select to find the rupees per the won rate? Now I need to take the cross currency, yes. However, there is bid and ask. So what rate should I select? Now we typically take the base currency approach where we say that our required rate is a rupees per the won rate, and hence the currency in the denominator is the won. What do I as XYZ, the customer, want to do with the won? Well, if I'm an importer, I want to buy the won. If I want to buy the won, so this is my relevant rate, base currency is a won. If I want to buy the won, the banker will want to sell the won, and hence the transaction will happen at the rupees per won ask rate. So over here, this is rupees per won ask rate. So my relevant rate would be rupees per won ask rate. Now when I look at rupees per won ask rate, I don't have a rupees per won rate given. I have the rupees to dollar rate given and won to the dollar rate given. So I have to arrange the rates in such a way that the dollar gets cancelled. So this dollar, being the intermediate currency, will get cancelled, and the rupees remains in the numerator and the won remains in the denominator. Now the relevant rate is the ask rate, so I'll take rupees per dollar ask and then dollar per the won ask. Perfect. Now rupees per dollar, I want rupees per dollar, the rate given in the question. Let us say if I take the 1st February rate and then the 1st March rate, the rate given in the question is also rupees per dollar. Ask rate is a higher rate, and hence the relevant rate I think would be 85.5. Further, so this is 85.5. I'll take it directly. I don't need to take any inverse. However, when I look at the second rate, I want dollar per the won. The question gives me won per dollar, and hence I'll have to take the inverse. But if I have to take the inverse, remember the inverse of the bid will give you the ask. So I'm taking the inverse and I'm using the bid rate, and hence 1390 should be my relevant rate. So I will take 85.5 into 1390, and that will come to 0.0615. That is the rate at 1st February. So if there was no changes at all, then the cash outflow that would happen will be 11,900 lakhs into rupees 0.0615, and hence 1 and 1 will get cancelled. This will be 731.85 lakhs. So this will give you the cash outflow at the 1st February rate. However, your actual cash flow is going to happen on 1st of March, and hence you need to find the cash flow under the 1st March rate. I would want you to pause the video at this point and select the appropriate rates and come to the rupees to the won 1st March rate. I hope you have tried this. The workings will be the same. You'll again have rupees per won ask, because you want to as XYZ buy the won, so the banker will sell, and hence rupees per won ask rate, which means rupees per dollar ask into dollar per won ask. Again, if you take over here 85.75 because the rates match, and if I have to take the inverse of the bid will give me the ask, and hence 1388, and hence your answer comes to 0.0618. Now one has to get cancelled, and hence if I look at the actual cash outflow at the 1st March rate, this will be 11,900 into 0.0618, so that is 735.42. Now for me, my cash outflow, I will prefer lower the better, but at 1st of March I am paying 735. if the rates had remained the same, that is 1st February ka, I would have paid 731, and hence the additional net cash outflow is my loss if I have to compare it with the 1st of February rates. So the net additional cash outflow, that is a loss, would be 735 minus 732, that is 3.57 lakhs net additional cash outflow, that is a loss if I do nothing of around 3.57 lakhs. Now this I would say is more of a cross rate application and understanding the market conventions of that Swift codes. So USD INR becomes rupees per dollar and so on. Now the second part over here is a non-deliverable forward. Now usually what happens is, in case of a forward, we say that okay, I want to buy the won, so the banker wants to sell and I will take the forward rate. When the time comes after 1 month, I will go to the bank, I will pay the agreed amount in rupees and get the won. The problem is, this is a non-deliverable forward. If it is a non-deliverable forward, this transaction, you will not go to the bank and pay the amount and get the entire won. In fact, you will settle by differences in prices, but that is your net adjustment gain or loss under the non-deliverable forward. You still have to pay the semiconductor company, and hence you will have to go to the spot market, get the won. Now that is very easy. I will go to the spot market on 1st of March, get the won, and that will probably cost me around 735.42 because I will have to go to the spot market on 1st of March, even if I take an NDF contract, because it's a non-deliverable forward. So then what is the point of taking non-deliverable forward? No, it gives me hedging, because if I have entered into a deal and if there is a change in the exchange rates, maybe there may be a gain or a loss for me, and hence my effective cash flow will be different. Okay, so it's a little complex, so let us get started. So there will be 2 legs of this transaction. Leg number 1, you have taken a non-deliverable forward and it will settle on 1st March, so there will be a gain or loss on that. And leg number 2, you have to pay to the South Korean company, and hence you will go to the spot market and do that deal, and hence both of them together will give you the combined effective cash flow on 1st March under the non-deliverable forward. That you can compare with the 731.85, which is the 1st February rate, to figure out how much is the effective gain or loss. Okay, so now what is happening is, things would have flown relatively smoothly, I would say, had the non-deliverable forward also been a rupees to the won. Now the problem over here is, in the non-deliverable forward, this is won to the dollar. Again, the settlement rate, this is won to the dollar, and as a result, now my contract necessitates me dealing in rupees on one side and won on the other side. But if I go to the forward market, unfortunately there is no rate, single or cross, which is available in the NDF market between rupees and the won. There is no rate. You can scan through the question, but unfortunately in the NDF market you cannot take the position of rupees to won. So what do you do? Well, right now you will have to see when you have to formulate the strategy, and there are different ways in which you can think. If you see the printed solution, you will find some other language being used, but the ultimate answer remains the same. The way we think is, well, you know what, let us look at the non-deliverable forward. The rates given for the non-deliverable forward is won to the dollar. Now this is your rate, and hence your base currency, the currency in the denominator of the NDF quote, is a dollar. So all your thought processes has to run from a dollar's perspective. What does XYZ as a customer do with the dollar? Thereby, what will the bank do with the dollar? Now, if I have to formulate the strategy, I know as an importer, I want to buy the won, not the dollar. Again, recap, listen, as an importer, if I want to do hedging, I want to enter into a position whereby the won will come to me. That is, I want to buy the won. However, the rates are not given on a per won basis. They are given on a per dollar basis. One option is you take an inverse and solve. Institute has not done that, but you can very well do. But if you want to stick to the direct method without taking any inverse, you can ask yourself that if the base currency is the dollar, my strategy is to buy the won. But if I want to buy the won 1 month down the line, what am I doing with the dollar? Won comes to me, I pay, give, sell the dollars. So my strategy technically should be buying the won, but the rate is quoted as won per dollar rate. So I have to rephrase my strategy in dollar terms. So I will say that, okay, I would love to buy the won, but if I'm buying the won on one hand, On the other hand, I'm paying the dollars. So my strategy will be to pay, that is sell the dollars. But if I am selling the dollars, the banker is buying it, and hence the transaction happens at the won to the dollar bid rate. This is where you will almost certainly trip, and if you don't, well, quite good, pat on your back. But even if you do, don't worry, it's a very complex thing, and hence it will need some iterations. But again, if you have done using the base currency approach, if you have done using some other approach like taking the inverse and solving, do it like that, no problem in that. So over here, if I take the base currency, my base currency in the denominator is the dollar. I'll again repeat for the, I know you can rewind and listen, but if my base currency is a dollar, my strategy has to be in dollar terms. So I will say that, well, how do I decide my strategy? Well, if I'm an importer, I need to buy the won. However, the contract is not priced per won, it is priced per dollar. Okay, I still want to buy the won. If I am buying the won on one hand, I will have to give the dollar on the other hand, and hence my strategy will be rephrased. I want to buy the won, that is, I will sell the dollars. But if I am selling the dollars, the banker is buying the dollars, and the banker buys the dollar at the won per dollar bid rate. Alternatively, you have said you can even take the inverse and solve, but banker buys at the bid rate. Now, if I look at the available rates, this is the bid rate 1390, and at this rate, how many dollars will I have to pay to get the 11,900 effectively? Hypothetically, notionally, if this was deliverable, hypothetically, then how many dollars will I need to pay so that I get 11,900 lakh won? So over here, XYZ would sell the dollar, that is buy the won, that is, well, over here, if won has to get cancelled, then I will divide so that the won gets cancelled, and your answer is in dollars. This is in lakhs. Institute, I think, has given this to you in full numbers, but you need to know what is this. This is what XYZ would have paid for 11,900. Now 1 month goes by, and after that the Bank of Korea gives the rate. Thankfully over here there is no bid and ask. They have given you a single rate, that is 1385, as you can see over here. Bank of Korea gives the rate. Now because it is a non-deliverable forward, whatever position I originally took, I'll have to reverse it. That is, I originally said that, well, you know what, I will pay, that is sell the dollars. Now if I have to cancel the position, I will enter a position whereby I will agree to buy. I will buy the dollars, that is, I will receive the dollars. I'll again repeat, if you are thinking from dollar standpoint, if you are thinking from won standpoint, it will be opposite. Like in dollar standpoint, I will say originally I had agreed to pay the dollars, so if I'm cancelling the contract, I will agree to receive the dollars. If you think from won's perspective, which is what Institute has written, I will agree to buy the won and then cancel it by selling the won. But the problem over here is figuring out the gain or loss. If you're able to figure that out, whatever method you do, it does not really matter. So I would say that I ultimately need to kind of pay the dollars. Initially I had agreed to pay the dollars. I can cancel it by taking the opposite position where I will receive the dollars. But how many dollars? Well, 11,900 into 1 divided by 1385. So notionally, we have clearly written over here, notionally, if you see, NDF settlement rate is 1385. So since NDF is non-deliverable, it will be settled by offsetting the original position. So if original position was XYZ to pay the dollars, it will be offset by XYZ receiving the dollars. But at what rate? 1385, the rate given by the Bank of Korea, and hence this will be 11,900 into. So this will be notionally the amount that you receive. So if I want to find a gain or loss, I would say notionally I would have agreed to pay 8.56. As you can see over here, I would have agreed to pay 8.56. Notionally, on settlement, I would actually get $8.59. So I will get $0.0309 as net settlement. Dollars, not rupees, not won, dollars. So over here, XYZ notionally pays 8.56. It notionally receives 8.59, but because this is a non-deliverable contract, it will net settle, and hence it net receives. There is a gain of $0.309. Now the problem over here is this is dollars. I want to figure out my effective position in rupees. So what will I do? Well, I will now look at the rupees to dollar rate, not rupees to won, not won to the dollar. I will look at rupees to dollar rate. I'll say that okay, on the from the NDF market at the end of the day, I will get 0.0309. And that, what do I need to do? Well, the base currency is a dollar. I need to sell the dollars that I have. So the banker will buy, and the relevant rate is a bid rate, that is 85.5. That is a bid rate if you go to see, and hence my effective net receipt, that is a cash inflow, that is a gain, will be 2.4620 lakhs. Now this is one leg of the transaction. Now some student might say, okay, sir, rather than doing all of this, I can directly compare 1390 and 1385. Well, you can do that, but you need to be very clear that this is whether it is a gain or is it a loss. And this is 1390 and 1385 are in won to the dollar terms. You need to find it in dollars. So as long as you are able to do it, you can solve it. But the normal error that I will see people making over here is they will probably not be able to clearly find whether it is a gain or a loss. Now ideally the thought process is, if I'm paying 8.56, that is a lower amount dollars, I'm receiving 8.59, that is I'm receiving more. That means I'm receiving more, so it is a gain. So if you are able to make sense of that, you do it like this. If you are able to do it by some other method, this second sub part, different people will solve using different methods. You will do the method which you are most comfortable with, you will do it. Okay, so this is something where you will have to again go back, review, recap, and get a better conclusion. Okay, so this is 2.6420. Okay, so am I a speculator? I will receive 2.6420 and rest out, zone out? No, I will have to pay to the Korean supplier, and hence I'll go to the spot market. In the spot market, it costed me, and we have done this earlier as well, it costed me around 735.42. Well, I still have to pay 735.42, yes, in the spot market to arrange. However, that cost in a way will be hedged by the gain from the non-deliverable forward. So 735.2 cash outflow, 2.64 cash inflow, and hence 732 I would say is my effective cash outflow. Now I would have ended the question by comparing 732 with around 735 and decided which is the better option. But the question has told us to compare this with the rates on 1st February. So if the deal happened at the rates on 1st February, the payment would have been just 731.85. We have done this in the first part, 731.85. However, we are effectively paying 732. That is, you are paying 0.928 lakhs more. So there's still a loss. There's a net additional cash outflow. That is a loss of around 0.928 lakhs. Now, if I have to decide, well, there are two places where there is a loss. I'll take the position where I have a lower loss, and I think in the second, the non-deliverable forward, I have a lower loss, and hence NDF option is selected. So this is the all important question number 9, which I would strongly recommend you do. Question number 10, I believe, is similar to our question 82 of the Forex section, which is there in the MTP of October 21. Question number 11, to be honest, is not really a different question. It's a very easy question. We'll review it, but it's not exactly the same. There is a small adjustment on PE ratio and synergy, तो अपन कर लेते हैं. Not more than 5 minutes for this question. There are two methods to which you can solve. Again, both will give you the same answer. C and P, both companies are operating in the same industry, decide to merge and form a new company S. Okay, so S is the acquirer. Relevant financial details of the two companies prior to the announcement are, so you have the earnings, number of shares. So if I want to find the EPS would be, I think, 2.5. This is around 5.8. P ratio 8 and 10. So if I multiply, and if I want to find a pre-merger market price per share basis, 2.5 into 8 will be 20. 5.8 into 10 will be 58. Now this is on a per share basis. You can even do it on a totality basis without going to the per share calculation. The merger will be effected by means of a stock swap. that is exchange of 3 shares of C for 1 share of P. So basically the 1 share of P over here is going to get what? The 1 share of P is going to get 3 shares of C. So 1000 into 3, that is equal to 3000 shares of C will be given to the shareholders of P. Now after the merger becomes effective, it is expected that due to synergic benefits, annual earnings post-tax are, this is also after tax, great, are expected to be 8% higher than the sum of the earnings of the two companies individually. So 10 plus, so this is 10,000 plus 5,800, 15,800 into plus 8%, total plus 8%. If I go to see, this is around 17,064. So this is post PAT. This is 17,064. Further, it is expected that the P ratio of S shall be the average of the P ratios of the two companies before the merger. So this is 10 plus 8 divided by 2, and hence this comes to 9. You are required to determine the extent to which the shareholders of P will be benefited on a per share basis from the proposed merger. So you want to find, in a way, if you do it on a per share basis, the impact analysis on the shareholders of P. You can even do it on a total basis, and we have showed you both the solutions. Like, first of all, if you do it on a per share basis, you will say what is the post merger EPS into the post merger P, which is 9 times, we will give you the post merger market price. So post merger EPS will be in the numerator, post merger PAT of 17,064 divided by 7,000. How? 4,000 plus around 3,000, and hence 2.4377 approx will be your post merger EPS into the average, that is 9, will be your post merger MPS 21.94. As we have found the price at 20 and 58, we can find the net gain on a per share basis, and institute ends at this. So this is for C, this is extra, they have not even asked you this, but 21.94 minus 20, and this is 1.94 gain, just for your understanding. Now one shareholder of P will effectively have 3 shares post the transaction, and hence 21.94, if it is on a per share basis into 3, will come to around 65.82. Compared it with 558, and then 7.82 will be the gain on a per share basis, and if you multiply by the number of shares, that will be totality basis. Institute ends over here at 7.82. Now this is one way of doing. The other way of doing is, you are saying forget the per share working, we will do that at the end. We look at on a totality basis. We say on a totality basis there is a post acquisition company of 15,800 profits, which is growing by 8% due to synergy, and hence this will be your post merger PAT into 9, which will be the average P ratio. This will be your post merger market value. Now this post merger market value will be enjoyed by C shareholders as well as P shareholders. Now we are not being asked anything about C, so we are not doing that. Institute has also not done that, but for P we will say they will enjoy. P shareholders earlier were 1,000, they are now getting 3 times, that is 3,000 shares. In the post combination entity of 7,000, they are having 3,000 shares. So 3 by 7 of the entire company will be the wealth attributable to P's shareholders, and hence this is 153,576 into 3 by 7 comes to 65,820 approximately, minus the pre-merger value of P. Well, P had profits of 5,800 and a 10 times P, and hence 58,000 will be the pre-merger market value, and hence 7,800 approximately would be the gain enjoyed by P shareholders. Now earlier P had 1,000 shareholders, so 7,820 divided by 1,000 will again come to this 7.82 itself. So the institute has also done it in the exact same way. You can either do it on a per share basis or on a totality basis. Now question 13 is like a mutual fund question where there's a crucial adjustment on calculation of cash, similar to question number 15 of our material, and it is also there, I believe, in the ICI study mat. International financial management, actually this is a foreign exchange question, which is question 78 on international investment, on which of the two opportunities that you have is better to invest. We have a question which has Japanese yen as well as the US dollar treasury, similar over here, and you are trying to figure out which of the options is better. Question number 78 if you want to review. Now the theory questions 14 and 15, within that the first theory questions on unicorn, which is earlier there. Then you have secondary participants in the securitization market, your primary, secondary theory questions are done. On this brief analysis of market indicators used for technical analysis, again something which is done like a breadth index, etc. Now there is a question which is there on the numerical side on exponential moving average, and at the end they tell you to figure out a buy or a sell signal. So that one of the ways is given over here, but in this theory question there are a few other ways which are also there, which is relevant from a theory standpoint. So maybe you can just review this. Again, parameters used to identify currency risk, which is there in the risk management chapter. So over here, how would buy and sell signals be provided by moving average analysis? Now this is hardcore technical analysis. Now institute expects you to be a pro in everything. So on hardcore technical analysis, they've given you this question on when will you have the buy and sell signal. Now typically we say that when you have the moving average line, and if your stock price line cuts from below, at that point there is a buy signal that gets generated. Or if there's a exponential moving average line which is kind of declining and the stock price line cuts from above, that's a sell signal. That is the conclusion in that exponential moving average sum which is there. However, over here there are multiple other signals which are also explained, like you get signals from your special one on sir, we are focusing on our studies. You'll get signal after you clear Z. So over here, when you are looking at these signals, what I've tried to do is I've just tried to explain. You can take a screenshot. It is not the best of the explanations. I mean, in terms of diagrams, it looks like worms going from here to there. But let's say the red line over here is a moving average line and the green line over here is the stock price line. When is a buy or a sell signal generated? When the stock price line rises through the moving average line, when the graph of moving average is flattening out. So almost a flat moving average line, but the stock price line cuts it from below. That is a buy signal. At this point, your buy signal gets generated. At the exact same level over here, the sell signal will get generated. Like the moving average line is a flattened line, but the stock price line falls. So you're falling. At that point, it is preferable that you sell. This is one, and I believe this is one of the questions which is also similar to your exponential moving average question. If you have to give the conclusion about the signal, trend bearish, bullish. Like if it's a moving up, bullish, moving down, bearish. But here they're not asking about the trend; they're asking about the signal. Okay, then stock price line is falling below the moving average line. Which is rising. So your moving average line is rising. Earlier your moving average line was flat. Now it is rising, but the stock price line is falling. The moment it cuts below that, there is a signal to buy. So why? Well, because if the moving average is rising and the stock is falling, it's like a correction which you think law of averages, it will again come back, and as a result the stock is now available at a cheaper price and hence you should buy. The exact opposite happens over here. That is when the moving average stock price line is rising through the moving average line which is falling. So if the moving average line is falling, the trend is generally bearish. But at that point, if the stock price is rising above it, then it's a good opportunity to book your profits and sell it, because the price is actually going up in a bearish trend. And the last one is the stock price line which is above the moving average, falls but begins to rise again before reaching the moving average. So it was falling, but before it reaches the moving average, it again starts rising. So there's no intersection here, but there is a signal that okay, the long-term trend is a positive trend and the stock price has started to increase, so might as well buy. The exact opposite, like if the stock price line, which is a slow line but begins to fall again before reaching the moving average line, over here we say that it has reached kind of a peak and it is now falling, so might as well sell it. So over here you need to be a technical pro. Sir, we are on Zerodha and grow more than your lectures. Avoid that for the time being. Uske baad CA banne ke baad you can do everything that you want. So right now just remember these signals, just try to remember these through these lines, and you can try to write it if a theory question comes. Most likely a question on this, if it comes, it will be more on the exponential moving average wala adjustment. Okay, so I think that should take care of your AFM RTP. I hope you've been able to get clarity on this. Wish you all the very best, study well, take care, and I'll see you soon with more videos. Bye bye.